All right, let's talk about one of the most exciting and, frankly, one of the most debated stocks out there in the whole AI and data space, Snowflake. You've got this incredible high growth company that a lot of investors absolutely love. But on the other hand, it has this sky high price tag, and man, can it be volatile. So that's what we're going to do today. We're going to break down the case for buying it and the case for maybe just watching from the sidelines.
And that's really the big question, isn't it? Is Snowflake a fundamental piece of our tech future? Something you'll kick yourself for not owning? Or is that valuation just way too rich to justify right now? Let's dig in and find out. Okay, first things first, what does Snowflake actually do? Before we even think about the stock, we've got to get under the hood, because the entire investment story is built on some really specific and pretty cool technology. So, at its heart, Snowflake is what's called a cloud data platform. The easiest way to think about it is like a giant, perfectly organized digital library for a company's data. I mean, all of it. Businesses can dump everything in there, access it in a split second, run all kinds of analysis on it, and now, this is the new exciting part. They can even build their AI models right on top of it. Now, this is what makes Snowflake's design so darn smart. The real secret sauce is how it separates data storage from the actual computer processing. What that means is a company doesn't have to pay for a ton of expensive computing power just to let their data sit there. They only fire up the engines and pay for them when they actually need to do something with the data. That efficiency is a massive, massive selling point for big companies. And on top of that brilliant core design, you get all these other great features. It scales up or down automatically, you can share huge amounts of data securely with a click, and you can throw pretty much any type of data at it. But look, here's where things get really interesting. Snowflake is making this huge strategic pivot. They're building powerful new tools right into the platform, trying to become the one-stop shop, the central brain for all of a company's AI ambitions. Okay, so that's the tech. It's cool, it's powerful, but how does that translate into a business that has Wall Street so excited? Let's dive into the numbers and look at the bullish side of the argument. First off, just look at this growth. We're talking 30% product revenue growth for the full year. And that's on an already huge base of business, which is just incredible. Even looking ahead, they're guiding for growth in the mid-20s. This is not some slow, sleepy company. This thing is a rocket ship. And this next number, this is where you really see the magic of their business model. A net revenue retention rate of 125%, that means your existing customers, the ones you already have, are not just sticking around. Nope, they're spending 25% more this year than they did last year. They keep finding new ways to use the platform, which is just a beautiful sign for the business. And we're not just talking about small startups here. Snowflake has gotten deep inside the biggest companies in the world. They have more than 400 customers that are spending over $1 million a year with them. That includes a huge percentage of the Forbes Global 2000. It's proof that this is a serious, enterprise-level platform. Now, this right here is maybe the most crucial point for the bulls. This isn't just growth at all costs. While Snowflake is growing like a weed, the actual business underneath is already super profitable on a unit basis. We're seeing product gross margins in the mid-70s and really strong free cash flow. That signals a very clear path to monster profitability as the company gets bigger and bigger. Okay, so that's the bull case. Sounds pretty amazing, right? But it is not that simple. For every bull, there's a bear with some really valid points. So let's flip the coin and look at the risks that make a lot of smart investors really nervous. Let's just get it out of the way. The valuation is, well, it's huge. The stock trades at a price that's way, way higher than its sales, often double what you'd see for an average software company. That means expectations are through the roof. And when expectations are that high, even tiny disappointments can cause the stock to just fall off a cliff. We saw it happen. Guidance slowed down just a little bit, and boom, the stock dropped like 10% in a day. It is definitely not for the faint of heart. Okay, this next part gets a little nerdy, but stick with me because it's super important. While those adjusted profits we saw look great, the company's official bottom line, the one that follows all the accounting rules, is still negative. Why? Well, a big reason is that they pay their employees a ton of money in stock instead of cash. And you can think of that like printing more money. It makes the shares that you own a slightly smaller piece of the whole pie. It just means the true profitability isn't quite as amazing as it might look at first glance. And you gotta remember, Snowflake isn't playing this game alone. Not by a long shot. They are facing some seriously intense competition.
You've got Databricks, which is a huge private company going after the exact same AI customers. And then you have the giants, Amazon, Microsoft, and Google. These guys literally own the clouds that Snowflake runs on, and they have incredibly deep pockets to build their own competing tools. So what does all this boil down to? It's really this one big question. That sky-high stock price isn't just about their awesome data business today. It's a huge bet that Snowflake is going to be a dominant force in AI tomorrow. If they can't actually pull that off, if they can't turn all this AI hype into real, durable, high-margin money, that valuation could get into serious trouble.
So, we've seen both sides. An absolutely top-tier business with amazing growth, but also a really expensive, risky, and volatile stock. So let's try to bring it all together to answer the only question that really matters. Is a stock like this a good fit for your portfolio?
Look, this isn't a simple buy or sell call. It's all about your personal goals and how much risk you can stomach. If you've got a long time horizon, you understand the tech space, and you won't lose sleep over big price swings, then yeah, a small tactical position in the high growth part of your portfolio could make a lot of sense. But if you prefer slow and steady returns, or if you already own a bunch of tech through ETFs, it is perfectly fine to just put this on your watch list and maybe wait for a much bigger pullback. So, to wrap it all up in a nutshell, what we have here is a fantastic, high-quality business that's growing like crazy. But it's attached to an expensive and volatile stock that has some very real risks, from competition to just plain executing on the AI dream. And at the end of the day, whether that trade-off makes sense, well, that comes down to you and your own personal investment style.
And that really leaves us with the classic dilemma you get with any innovative, high-flying company. What's the real risk here? Is it missing out on what could be the next huge thing? Or is it buying into all the hype right at the peak, only to watch it come back down to earth? That's the question to chew on.